Hi everybody, this is the first lecture for week 13 and this lecture is for topic number 8. Topic number 8 is about cost, volume, profit relationship. In this topic, you will learn about the relationship between cost, volume. Volume is the quantity of production, and profit. So you will see what happen if cost increases. What is the effect of that on the profit, and also what will happen if volume increases. What is the effect of that on profit and cost, etc. So the relationship between these three factors: cost, volume, and profit. I think this topic is not very difficult, and if you can understand the relationship and then you can memorize the formula, you can answer all questions related to this topic. Okay, this is the first thing that you have to know about or have to know in this topic. First, you see here, this is a new or another format for income statement. Remember, when you learn about financial accounting, you have learned about how to prepare financial statement. How to prepare an income statement. Income statement is a document that you can use to calculate profit or loss for a business. And then when you learn about financial accounting, the format of the income statement is like this: revenue, and then minus expenses, and then you will get the profit or loss. And in topic 6, you have learned about how to prepare income statement for a manufacturing business. You have seen that the way to calculate profit for a manufacturing business is like this: revenue, then minus cost of goods sold. You will get gross profit, and after that you have to minus the expenses, and then you will get the net profit. Okay, that is one format of income statement. In management accounting, there is another format of income statement. We call it contribution income statement. You can see the contribution income statement here in this slide, in the gray box here. So you see the format is simpler. So you can see here in this gray box, the format is like this: sales revenue. In this sample income statement, the sales revenue is 250,000 minus variable expenses or variable costs, and then you will get an item called contribution margin. After that, you have to minus fixed costs or fixed expenses, and then you will get the net profit. Okay, in this sample income statement, the sales revenue is $250,000. The variable expenses is $150,000. So the contribution margin for this business is $100,000. And then minus fixed expenses for this business is $80,000. So the net profit for this business is $20,000. So you have to know how to prepare this income statement if you are asked in the exam or in assignment or anything. So this is called contribution income statement. So also you can see here the contribution margin. So the contribution margin is very important in management accounting. So you can see here the contribution margin. There are two aspects of contribution margin. In this income statement, you can see there the contribution margin for this business is the revenue minus variable expenses. For the total contribution margin, the amount is 100,000. Because the revenue is 250,000, the variable cost is 150,000, so the total contribution margin is $100,000. That is contribution margin or total contribution margin. Another way to see, or another aspect of contribution margin is unit contribution margin. You can see in the column number 3 in the income statement, unit contribution margin, the calculation is unit price for the product. In this example, the product is bicycle, and minus unit variable cost. So the unit price for the bicycle is 500,000 minus unit variable cost or variable expense is 300. So the unit contribution margin is $300. So you have to know about this. If somebody asks you calculate contribution margin or total contribution margin, so you have to know how to calculate that. In this example, the total contribution margin is 100,000. Then if somebody asks you calculate unit contribution margin, so you have to remember the formula. Unit contribution margin is unit price minus unit variable cost. So in this example, 500 minus 300, so the unit contribution margin is 300. Okay, so I hope you can see the format. Very easy to calculate or to prepare this income statement. It's very easy to prepare, and also is very easy to understand. Most managers prefer to see contribution margin or contribution income statement, because they can see clearly how much is the revenue for their business or their department, and then how much is the variable cost and how much is the fixed cost, and also they can see whether the business or the department is making profit or loss. Managers, they prefer to see the cost to be divided into two categories, fixed cost and variable cost. Why manager like to see these two categories of cost? Because they know variable cost can be controlled in short term. If you are a manager, you know the variable cost can be controlled in short term, because variable cost is a cost that will increase and decrease according to the quantity of production. Most of the time, you can do something to minimize the variable cost or variable expenses. But fixed cost is a cost that cannot be controlled. Most of the time, fixed costs are fixed in short term. For example, the rental, depreciation. So if you are a manager, you know that this cost cannot be controlled. You cannot decrease or reduce this cost. As a manager, you always have to think about how to minimize costs, how to maximum profit, etc. So you can, most of the time, you can control variable cost but not fixed cost. Okay, so see the blue box here. Contribution margin is the amount remaining from sales revenue after variable expenses have been deducted. So in general, contribution margins equal to revenue minus variable expenses or variable cost. Okay, this one is important too. See here, another point in the blue box here, contribution margin goes to cover fixed expenses. Okay, see here, after covering fixed costs, any remaining contribution margin contributes to income. So you can see in the column number 2, the slide says contribution margin is covering the fixed cost. So you can see in the column number 2, in this sample business, the contribution margin is 100,000. And then the fixed cost or fixed expenses is $80,000. So you can see here, the contribution margin is the amount that will cover the fixed cost. If the contribution margin is higher than the fixed cost, then the business will make profit. And if the contribution margin is lower than the fixed cost, then the business will making loss. If the contribution margin equal to the fixed cost, then the business is making zero profit. No profit and also no loss. So you can see here in this sample income statement, the contribution margin of this business is 100,000. The fixed cost is 80,000. So the business is making profit 20,000. Why the business is making profit? Because the contribution margin is higher than the fixed cost. If the contribution margin is lower than the fixed cost, then the business is making loss. So this is also explaining about the contribution margin. Okay, see here. For each additional unit Win sells $200 more in contribution margin will help to cover fixed expenses and profit. Okay, I think you can understand this. The name of this business is Win Bicycle Company or something. The product is bicycle. This business selling bicycles. So you can see here, in this income statement, the sales quantity is 500 bicycles. This business sells 500 bicycles. And you can see the unit data there. The price per unit for a bicycle is $500. So the total revenue is $250,000. Why $250,000? Because $500 times 500 bikes, so the total revenue is $250,000. The second thing that you can see here is the variable expenses or variable cost. The variable cost, remember the definition of variable cost. Variable cost is a cost that will change when the quantity of production changing. So you can see here, for this bicycle, the unit variable cost or variable cost per unit for this bicycle is $300. So if the business sells 500 bicycle, then how much is the total variable cost? Total variable cost is $300 times the 500 bicycle. Variable cost is will increase when the quantity increases. So $300 times 500 bicycle equal to $150,000. So that's why the total variable cost is equal to $150,000. Unit contribution margin is 200. The total contribution margin is 100,000. Okay, so every time the business sell one unit bicycle, there will be an increase in in contribution margin by $200. So this $200 will cover the fixed expenses, and also after the fixed expenses are covered, the business will make profit. So the thing that you can understand. Next thing, each month, Win must generate at least $80,000 in contribution margin to break even. So break even. So you can see here, the fixed expenses of this business is $80,000. So it shows that every month this business has to generate at least $80,000 to break even. If the contribution margin is $80,000, then $80,000 contribution margin minus fixed expenses also $80,000. So the business profit will equal to zero. when the business has zero profit, then the situation is like this. When the business does not make any profit or loss, or zero profit, the situation is called break even. Okay, so let's say you have a business. Let's say you have you open a small burger stall in School of Business. So when you open the small burger stall, you sell the burgers to students. So when the total revenue from your sales equal to your total cost, the situation in accounting, the situation is called break even. After the break even point, if you can sell more burgers, then you will make profit. Before the break even point, you are making loss. Okay, so that the same thing happened to this business. If the contribution margin is 80,000, then the business will achieve the point of break even. See here, for this bicycle company, if for this bicycle company, the contribution margin of the company will achieve $80,000 if or when the company sells 400 bikes. If this company can sell 400 bikes, then the contribution margin of this business will become 80,000. The fixed cost also 80,000. So in that situation, the business is achieving the break-even point. So most businesses, for them, the most important thing to achieve is break-even point, because they know after the break-even point, if they can sell more, they will make profit. Before break-even point, the business is making loss. See here, when the business can sell 401 bikes, the business is starting to make profit. The profit is $200. When the business can sell 401 bikes or bicycle, the business will make profit $200. $200 is equal to the unit contribution margin. So you can see the contribution margin will cover the fixed expenses. After that, the contribution margin is the profit of the business after the contribution, after the break-even point. So you can see here, this is the situation or scenarios showing the relationship between cost, volume, and profit. So you can see here, first column shows the items, sales, variable expenses, contribution margin, fixed expenses, and then net profit. And then the second column, third column, and fourth column shows the data if the business can sell 300 units, 400 units, and 500 units. So you can see here, if the business can sell 400 units, the business will achieve the break-even point. Break-even point is the point where the business does not make any profit and also does not make any loss. So before the break-even point, the business is making loss. See when the business can sell only 300 units, the business is making loss 20,000. And also you have to understand that after the break-even point, the business will start to make profit. You can see here, the break-even point is 400 units. If the business can sell 500 units of bicycle, the business will make profit. The profit is equal to 20,000. So this is the thing that you have to understand first. So what have you seen? First, you know now about another format of income statement. You have seen the first slide. The income statement is called contribution income statement. The format is like this: total revenue minus total variable expenses equal to contribution margin minus total fixed cost equal to profit or loss. And then the second thing that you have learned is contribution margin. There are two ways or two aspects of contribution margin: total contribution margin and also unit contribution margin. And then the third thing that you have seen or learned is about the relationship between the unit of production and the profit, and also about the cost. So you can see here the business can achieve break-even point when the contribution margin equal to the fixed cost. Before the break-even point, the business is making loss. After the break-even point, the business is making profit. Okay, this graph shows about the relationship between the cost, volume, and profit graphically. You can see here. Okay, break-even point is the point where total revenue equal to total cost. At that point, profit equal to 0. Before the break-even point, you can see the break-even point is the point where the line of revenue and cost intersect. So you can see arrow for the break-even point here. The arrow is there. So, and then before the break-even point, the business is making loss. Okay, you can see in the loss area, the cost is higher than the revenue. After the break-even point, the business is start to make profit. After the break-even point, you can see the total revenue. Total revenue is the red line. Higher than the total cost. The total cost line is the black line. Okay, this is the next thing. Before this slide, you have you learn about contribution margin. So now you learn another thing. This thing is called contribution margin ratio. So very easy to remember. If somebody asks you how to calculate the contribution margin ratio for this business, so the formula is, you can see here, the formula for the contribution margin ratio is equal to total contribution margin divided by total sales. Okay, there are two ways to calculate contribution margin ratio. This is the first way or the first method. The formula is total contribution margin divided by total sales. So you can see for the wind bicycle, the CM ratio is total contribution margin $80,000 and the total sales is $200,000. So the contribution margin ratio for this business is 40%. So how to get the $80,000 and $200,000? So you can see the previous slide. See here. In the column number 3, you can see the contribution margin is $80,000 and the total sales is $200,000. So the contribution margin is 40%. If you use data from other scenario, you will get the same answer. The CM ratio is equal to 40%. You can use data for 500 units. If you use data for 500 units, then the CM ratio equal to 100,000 divided by 250,000. You will get 40%. If you use data 300 units data, the CM ratio is 60,000 divided by 150,000. You will get the same answer, 40%. So the contribution margin of a business, CM ratio for a business is always same. The ratio is same. No matter at what point of production you use data, you will get the same ratio. Okay, this is the first method to calculate contribution margin ratio. The second method is you can use unit data. So the unit data, the formula is contribution margin ratio equal to unit contribution margin divided by the selling price. I think this is easier. You just collect the unit data. So the bicycle company, remember the bicycle company, the unit contribution margin is $200. Why $200? Because the unit contribution margin is equal to $500, the price, minus the unit variable cost $300. So unit contribution margin is $200, divided by the unit selling price of the bicycle is $500. So the answer is 40%. So same. That's why I said there are two ways that you can use to calculate the CM ratio. You can use total data, like you have seen in the previous slide, or you can use unit data, like you can see here, unit data. Okay, I think it is easier to use unit data. Okay, so see here, this is a sample question, how to use the contribution margin ratio to understand something about the business. Okay, let's see here. At Win, so you know now, for the Win company, Win bicycle company, the contribution margin ratio is 40%. So it shows that at Win bicycle company, each $1 increase in sales revenue results in a total contribution margin increase of 40 cents. That's what the CM ratio figure or percentages shows about. It shows that for this business, for every $1 increase in sales, there will be an increase in contribution margin by 40 cents. 40 cents because it is 40%. If the CM ratio is 50%, then the contribution margin increase by 50 cents. So see the black sentence here. If sales increase by 50,000, what will be the increase in total contribution margin? So the answer is 50,000 times 40%. So 50,000 increase in sales revenue results in $20,000 increase in contribution margin. So the question that is related to contribution margin ratio is like this. You can see here. This is a sample question. So let's say Coffee Clutch is an espresso stand in a downtown office building. The average selling price of a cup of coffee is $1.49, and the average variable expense per cup is 36 cents. The average fixed expense per month is $1,300. 2,100 cups are sold each month on average. What is the CM ratio for Coffee Clutch? Okay, so this question asks what is the CM ratio. So you know there are two ways that you can use to calculate the CM ratio, isn't it? You can use total data or unit data. So let's see here. So here you have unit data, so easier for you to use unit data. So CM ratio equal to unit contribution margin divided by unit selling price, so $1.49 minus 36 cents divided by $1.49. So the answer is, for this coffee clutch business, the CM ratio is 75.8%. So what you can understand by the number 75.8%? It shows that for every dollar increase in sales, there will be an increase in contribution margin by 75 cent, 75.8 cent. So changes in fixed cost and sales volume. So this is another thing that you have to understand in this topic. You can see here the effect of changes in cost and sales volume on the items like quantity of production or profit. Okay, let's see here. Win is currently selling 500 bikes per month. The company sales manager believes that an increase of $10,000 in the monthly advertising budget will increase bike sales to 540 units. So the question is, should we authorize the requested increase in the advertising budget? Okay, so the situation is like this. The Win bicycle company now selling 500 bikes per month, and then there is a new suggestion by the sales manager. The suggestion is like this. The sales manager suggested that the business has to increase advertising budget by $10,000. If the business increase the advertising budget by $10,000 per month, it is expected that the bicycle sales will increase to 550 units. So you can use your knowledge about CVP analysis to analyze this suggestion. You can use your knowledge to assess or examine whether it is good to accept the suggestion or it is good to reject the suggestion. So the question asks you, should we authorize the requested or suggested increase in the advertising budget? So how to do the analysis? The analysis is easy. You compare profit before the suggestion and profit after the suggestion. If the profit increase, then you accept the idea or suggestion. If the profit is getting lower, then you don't have to accept the suggestion. Okay, let's see here. That's what I said. To answer this question, you compare the profit before the suggestion and profit after the suggestion. Okay, you can see here in the column number 1, in this gray box, this column number 1 shows the items, sales, variable expenses, contribution margin, fixed expenses, and net operating income. In the second column, you can see the current sales or the income statement before the suggestion. So the income statement before the suggestion, the sales is 250,000, variable expenses 150,000, contribution margin 100,000, fixed expenses $80,000, the profit is $20,000. And then the column number 3 shows income statement after the suggestion, or income statement if the suggestion is accepted. So you can see here, projected sales 550 bikes. Assuming that if the business accept the suggestion, the sales quantity will become 540 bicycle per month. So if the sales is 540 bikes or bicycle, the sales will increase to 270,000. Why 270,000? Because one bike, the price is $500 times 540 bikes, so the total sales or revenue is equal to $270,000. Variable expenses also increase. Why the variable expenses increases? Because you have to remember, variable costs are costs that will increase when the quantity of production increases. In this sample bike business, bicycle business, the unit product cost is unit variable cost is $300. So one bicycle, the unit variable cost is $300. If the sales is 540 bicycles, then $300 times 540, so the total variable cost is $160,000. And then you will see that contribution margin is $108. Sorry, $108,000. We are now in column number 3. So the contribution margin is $108,000. And then the next item is the fixed expense. If the suggestion is accepted, the fixed expense will increase by 10,000 because the business has to pay advertising cost $10,000 per month. So that's why you see in the column number 2, the fixed expense is $80,000. But in column number 3, if the suggestion is accepted, the fixed expenses will increase to $90,000. There will be an additional of $10,000. So, and then you see the net operating income or net profit. In column number 3, you can see there, the net profit is $18,000. So, you can compare profit before the suggestion and after the suggestion. Profit before the suggestion is 20,000. Profit after the suggestion is 18,000 only. So what do you think? Is it a good idea to accept the suggestion or to reject the suggestion? According to the numbers, according to the profit numbers, the suggestion has to be rejected. Why? Because profit after the suggestion is lower compared to profit before the suggestion. If you are a businessman or a manager, you will choose the production process or the strategy that maximize your profit. If you accept the suggestion, then the profit is lower than the before the suggestion. That's not a good idea then. Okay, this is a shortcut, but I think the best way to make the decision is to compare the profit before the suggestion and after the suggestion. Okay, this is the end of the lecture 1, part 1. Do not forget to write your name and metric number in the comment section. That is your attendance for today's lecture. Thank you very much.